Very happy to be here. I represent the insurance sector, and I have a short presentation from a slightly different perspective, meaning I will try to deal with what makes an investment tick from a different perspective of governance, different perspective of shareholders. And I will try to do that by giving you the story of our company, Eurolife. Eurolife is one of the largest insurance companies in Greece. Let me say a couple of words about the insurance market in Greece. The insurance market in Greece, and I'm speaking about both life and non-life. Any KPI you look at, it's at about a quarter of the European averages. So one way to look at it is that it is perennially underdeveloped. The other way to look at it is that there is opportunity. So this company, Eurolife, started in the year 2000. It started within the folds of Eurobank, and Fokion Karavias spoke about Eurobank earlier today, I think. And in the year 2000, bank assurance, i.e. selling insurance through bank channels, was relatively new and exotic in Greece. So at that time, the management of Eurobank got the idea, rightly so, that by selling insurance closely related to loans, meaning life insurance associated with loans, and property insurance associated with loans, it would make sense, and it would be a good business proposition. At the same time, as we're talking about creating shareholder value, bank assurance was clearly not the core business of a bank, such as Eurobank. It was a business opportunity. And the governance of bank assurance was geared towards taking advantage of that opportunity within the folds of the bank. That means that there was a small insurance company at the time doing certain lines of business, as I mentioned before, associated with loans only. And all the rest, even though the company had to be an independent company, an insurance company, at the same time, everything else was governed by the bank, from HR, remuneration policy, IT, etc., etc. This company started and was doing well, and will continue to do well in the good times that we all remember up to 2004. At that time, my friends at the bank, and at the time I was CEO of an international group, Allianz, in Greece, determined that just having this limited insurance exposure was not taking advantage of the opportunity in the insurance market. And at that time, I and my colleagues in the management team joined to turn Eurolife into a quote-unquote real insurance company, meaning multi-line, so lines that were not necessarily associated with loans only, and multi-channel, meaning not only bank assurance, but other channels, maybe less fashionable, especially to bankers, such as traditional agents or brokers, and so on and so forth. So in 2004, Eurolife started. And Eurolife did very well as still a company within the folds of the bank, but with a broader mandate. Then obviously the international crisis ensued, the Greek crisis ensued, and at some point, the bank had to sell non-core businesses such as Eurolife. So at that point, we were sold to Fairfax. Fairfax, who is our current core shareholder, can be described as a fund or as a private equity, if you will, much like Berkshire Hathaway in the US, where insurance is the core business, and then Fairfax never sells its insurance businesses. But with the investments of the insurance business, Fairfax makes tactical investments, such as the investment in Eurobank in Greece and other investments in many other countries. So what happened there was a fundamental change in how the business was viewed. From a side business to banking that was doing well and was making money and making good returns, it became the core business. And the difference there was that instead of just focusing on the top line, without really understanding, if you are in another business such as banking, insurance is not your core, you don't necessarily understand the fundamentals of the business. This changed now, and let me just open a short parenthesis for those in the audience who don't know insurance. Think of it this way: if you insure your car, you give us your insurance premium, and until you have an accident, at which point we set up a reserve and or pay the claim, we invest the money. So in insurance, you have an underwriting result, what we call technical result, and you have an investment result. For those of us like me who are many decades in the insurance business, there is one lesson to be learned, and that is you focus on the underwriting result. You have to make technical result, positive technical result, premiums minus reserves minus claims. And in the meantime, obviously, you have to make a good investment result. Under Fairfax, there was and is a brutal focus, I would say, to making a positive underwriting result. And of course, Fairfax are experts in generating investment results as well. There is a fine line, as in Greece and all of Europe, we operate under Solvency II, is a risk-based capital model with governance and other features. So investments for an insurance company are not as simple, and simple is not the right word, but anyway, we have to not just try to maximize return, we have to maximize return vis-a-vis risk, vis-a-vis capital requirements, etc. But getting back to the main point, under Fairfax, the main point is you have to make underwriting result, you have to optimize your investment result, you have to follow the compliance and solvency rules and capital rules. And management is incentivized to do that in a very pure play way, if you will, as opposed to in other organizations where insurance is not the core business. So things get diluted as to what you're really chasing and what you're incentivizing clients, managers for. And then you have a sufficiently long investment horizon, an investment horizon that is pure and is only focused on your business and your underwriting result and the particularities of that business, as opposed to being part of a larger picture. Needless to say, the magic recipe in this is to have the right people to do all this. And as I said before, to have them incentivized for specific goals. This has resulted in a company which is today's Eurolife. Eurolife today is the third largest after the latest mergers in our industry, third largest insurance company by volume, at approximately 660 million gross written premium this year. We manage 3.5 billion euros in investments, employ 450 people in headquarters, and there's about 5,000 agents, people selling our insurance, plus Eurobank under the bancassurance agreement, plus maybe a third of our volume is generated through affinity programs and other direct kind of programs. This company has now blossomed to a company with a book value of 900 million euros. And last year we had 115 million euros in after-tax earnings. It is important to note that within this result, year over year, 20 to 40, 50 million euros is underwriting result, comes from the underwriting result, and the rest comes from investments. So the bottom line here is that while you can, and one more important number, since the acquisition by Fairfax, we have generated 34% annualized return on the capital invested. So my message here is this. There are many ways to generate value, and there are and many ways to get to the target. But what I have seen as a manager is, while having brilliant, I would say at the time, banker shareholders who saw the opportunity in a non-core business to generate value and proceeded to do that, when you move into shareholders whose focus is your business and only your business, and therefore the entire business model is targeted, is focused on specific areas, particular to insurance in this case. And one more thing, it's a trademark of Fairfax. As a manager, you get a free hand with very clear goals, clear incentives, but you get a very free hand in chasing those numbers. Then the results improve even more. And one last point with which I want to close, maybe for Professor Athanasakos, it will be an idea for some research. Eurolife is number 3, was number 2, at one point was number 1, but is always in the top 3. But anyhow, in the recent years has never been number 1 in volume, but has been consistently number 1 in book value, in generating net asset value, which is a core fundamental, I think you will agree with me, and has been number 1 in generating profits. And somewhere I read that across industries, many times you find that the one who's number 1 in top line is seldom number 1 in generating value and generating profits. So maybe I always wondered whether this is true or not. So thank you very much.